Welcome back to the deep dive. It is February 22nd, 2026. And I have a confession to make right up front.
Oh, boy.
Yeah. For the last, I don't know, 3 years, I have been absolutely obsessed with the central bank.
You and everyone else in the commercial real estate world.
I mean, I'm talking refreshing the page, watching the dot plot, listening to every single word the Fed chair says like it's gospel.
Right, because we were living in the interest rate era. The only thing that really mattered was the cost of money.
Exactly. It felt like if we could just predict where rates were going, we'd have the cheat code for the economy.
Yeah.
But looking at the stack of research we have today, we've got white papers, market signals, some really interesting analysis from Rutherford International. It looks like my obsession is officially outdated.
It definitely is. Honestly, staring at interest rates right now is like driving a car while looking exclusively in the rearview mirror.
It's old news.
Completely old news. The road ahead isn't about the cost of capital anymore. The paradigm for 2027 and beyond has shifted to what we call the capacity ceiling.
The capacity ceiling.
Yeah.
So our mission for this deep dive is to unpack exactly what that means, right?
That's right.
We're going to look at why housing affordability, labor mobility, and infrastructure, specifically power and transit, have totally replaced interest rates as the main drivers of economic growth and real estate demand.
And we've got a lot to cover.
We do. We're also going to do a deep comparison between the Canadian market, which seems to be defined by constraints and friction right now, and the U.S. market, which is defined by this aggressive mobility.
It's a really stark contrast.
So let's jump in, the capacity ceiling. It sounds very physical.
Because it is physical. That's the whole point. We
Yeah.
spent years worrying about financial constraints. Can I afford the loan? What's the basis point spread?
Right.
Now, the constraint is tangible. It's dirt, it's concrete, it's copper wire.
Okay, let's pause there because that's a huge claim. You're saying that even if the bank gives me a loan at 0% interest, I might still be stuck.
Exactly. Let's look at the first pillar from our sources, which is housing. The research introduces this concept of housing affordability acting as a de facto interest rate.
Explain that. How does my rent payment act like a central bank rate?
Well, think about it from the perspective of a CEO. Let's say you run a tech company or a logistics firm. It's February 2026, and the Bank of Canada has cut rates to 2.5%.
Which sounds great.
On paper, yeah, money is cheap. You should be serving that cheap capital by borrowing, say, $50 million to expand your headquarters in Toronto or Vancouver.
Right. Finance 101, cost of capital is low, so I invest in growth.
But here's the snag. You build that office, you open the doors, and nobody comes to work.
Why?
Because your workforce literally cannot afford to live within a 90-minute commute of your new building. If the average rent is $4,000 a month and your entry-level salary is $60,000 a year, the math just doesn't work.
So the housing market is effectively putting a brake on my business growth, just like a high interest rate would.
Precisely. It sets a hard floor on your growth. You can't hire, so you can't scale.
Wow.
The sources highlight that we've moved from a cyclical challenge where prices just go up and down with the market to a structural one.
Meaning it's baked into the system.
Yes. The ecosystem's ability to house and move people is now the fundamental bottleneck for business continuity.
It's wild to think about housing as a business continuity risk. We usually talk about it as a social issue or maybe a personal finance nightmare.
Right.
But you're saying it's actually a physical cap on commercial real estate value and corporate growth.
It is the systemic ceiling. And to really see how this plays out, we have to look at our tale of two markets.
Either versus the U.S.?
Exactly. We have the Canadian market, which currently is defined by friction, and the U.S. market, specifically the Sun Belt, which is defined by this concept of aggressive mobility.
Aggressive mobility. I definitely want to get into that term because it sounds intense. But let's start with Canada.
Sure.
The research mentions something called the exit fee. Is this a government tax?
No, it's not a tax you pay to the CRA or anything. It's a market reality.
Okay.
Think about the housing costs in Tier 1 hubs like Toronto or Vancouver. The cost of entry is so astronomically high that it acts as a barrier to newcomers. But it also traps people who are already there.
Traps them how?
Imagine you bought a condo in Toronto 5 years ago. You have a decent rate, maybe you have some equity. But if you sell that and try to move for a new job, the transaction costs, the land transfer taxes, and the price of the next home are so high that you effectively lose money by moving.
So you stay put.
Right. You don't take the new job, you just stay where you are.
So the labor force is frozen in place.
And it gets worse when you try to move across provinces. This is the internal friction part.
The skills friction.
Exactly. Let's run a hypothetical. Say you are a master carpenter in Halifax. You're really good. You're fully certified.
Right here.
There's a massive construction boom in British Columbia, and they are desperate for carpenters. They're paying double what you make in Nova Scotia.
So I pack my truck and go. Right. That's the Canadian dream.
You'd think so. But when you get to the BC border, your certification might not be recognized.
Wait, seriously?
Yes. You might have to recertify, pay administrative fees, maybe even do an apprenticeship period all over again.
I'm a master carpenter in one province, but I'm treated as unskilled labor in another.
In many trades, yeah. The sources estimate that these interprovincial trade barriers, this complete lack of mutual recognition, reduces worker mobility by an estimated 7 to 12%.
7 to 12%.
It's what economists call a welfare loss.
Welfare loss sounds like a really polite way of saying we are setting money on fire.
That is exactly what it is. We are leaving billions of dollars of GDP on the table because a piece of paper in Halifax isn't valid in Vancouver.
So labor is sticky. It doesn't flow to where the work actually is.
Right, which explains why we're seeing this massive Alberta effect.
Right, the migration to Calgary and Edmonton.
Capital and labor are rotating toward the prairies. It's not just about oil prices anymore. It's because those are the last frontiers of mobility in Canada. It's one of the few places left where a normal person can move, find a house they can actually afford, and get to work without massive friction.
Okay, so Canada is the land of friction. Now take me to the U.S. You used the phrase aggressive mobility.
Yes.
To me, that sounds a bit dystopian. Like nobody has job security, so they're forced to just run around the country chasing gig work. Is that what we're talking about?
That's a pretty cynical take, but I see where you're coming from.
Am I wrong?
The data frames it differently. It frames it as elasticity. The U.S. market, particularly states like Texas, operates as a pressure valve.
A pressure valve?
Yeah. You have frictionless frontiers, right-to-work laws, no state income tax, and crucially, it is much, much easier to transfer your skills across state lines.
I saw a stat in the notes about Austin, Texas that frankly seemed impossible to me. A renter mobility rate of 54%.
It's a real number.
Does that mean over half the renters in the city relocate within 2 years? That sounds chaotic.
It sounds chaotic if you value total stability above all else. But, economically speaking, it's incredibly healthy because it means the market is fluid. If a renter in Austin gets a better job offer on the other side of town, or even in a different city entirely, they can just leave. There's enough housing supply that they can easily find a new place.
Whereas in Toronto...
In Toronto, people hold on to their leases with a death grip, because if they let go, they might never get back in.
Right.
So in Austin, if you build a new factory, the workers can physically route themselves to where the jobs are growing.
Because the philosophy is if you build it, people can and will move there.
Exactly. The supply of housing is highly elastic, which means the supply of labor is elastic. In Canada, we have a rigid supply of housing, so our labor supply is completely rigid.
Okay, so we've established that human beings are having a hard time fitting into the economic engine because of housing and friction.
Yes.
But here's where the research takes a turn that I found really fascinating. Even if we solve the housing crisis tomorrow, snap our fingers, everyone has an affordable home. You're saying we hit another ceiling.
We hit the hard cap.
The hard cap.
This is the sleeping giant of 2026. We are moving from a constraint on people to a constraint on machines and infrastructure.
Specifically, power and transit.
Yes, power and transit.
I feel like for the last decade, industrial real estate was so simple. You find a flat piece of dirt near a highway, you build a big concrete box, you lease it to Amazon, and you're done.
Oh, those were the glory days.
Not anymore.
Not anymore. Now, site selection is entirely filtered by one metric, megawatt availability.
Is this just because of the AI boom?
It's the biggest driver, yes.
Yeah.
The AI boom, the massive energy demands of data centers, the general electrification of everything, they are voracious energy consumers.
Right.
But it's not just a question of can we plug it in, it's a timeline issue.
What do you mean?
Let's say you buy a prime piece of land for a data center. You have the zoning sorted out, you have the capital ready to go, you go to the local utility and ask for 50 megawatts of power.
And they say, sure, we'll look you up on Tuesday.
No, they say, sure, we can get you that power in 2031.
5 years.
If you're lucky, they have to upgrade substations, they have to build new transmission lines, they have to get regulatory approval. It is a slow, bureaucratic bottleneck.
Right.
That's why we are seeing this insane premium right now. Industrial sites that are powered, meaning they have, say, 10 megawatts of pre-allocated power ready to go. They're trading at a 15% premium over traditional logistics space.
A 15% premium just for the power allocation.
Just for the megawatt availability. Without it, development simply stalls.
So the power cable is worth more than the dirt.
In many cases, yes. It completely changes the definition of prime real estate. It used to be location, location, location.
Then now
It's location, location, interconnection.
location, location, interconnection. I like that.
It's the reality.
But power is for the machines. Transit is for the people. We talked earlier about housing pushing people further out of the city centers.
Right, and this brings us to a concept called commute failure.
Commute failure.
Yes, if affordability pushes your workforce 45 minutes out of the city, that's fine if the train runs and it runs well.
Which it often doesn't.
Exactly. If the transit capacity hasn't kept up with that suburban surge, you get a massive degradation in quality of life.
The commute becomes a nightmare.
Right. And that eventually leads to commute failure, where the employment relationship breaks.
You mean people just quit because they can't handle the commute anymore?
Or they never apply for the job in the first place.
Right?
This is why assets within a 5-minute walk of major transit hubs are trading at a 20 to 30% premium right now.
20 to 30%. That's huge.
It's not just a convenience anymore. It is a baseline necessity for accessing a functioning labor pool.
Which segues perfectly into the office market.
Yes.
Because if people are commuting, they're going to an office. Are we still debating return to office in 2026, or is that argument finally over?
Thank goodness that war is officially over. The debate is settled.
And who won? Remote or office?
Neither. The winner is structured hybrid. It's not fully remote, and it's not 5 days a week in a cubicle. It's a structured 3 to 4 days in the office.
Okay, 3 to 4 days, but not just any office.
No, and this is critical for anyone looking at investments right now, because companies need less total space. With a 50 to 60% hybrid adoption, they are renting better space.
A flight to quality.
Exactly. A massive flight to quality. If you are forcing your employees to commute on a crowded train for 45 minutes, you absolutely cannot put them in a beige cubicle farm from 1990.
It won't work.
No. The office has to be an experience. These Class A+ offices are commanding huge premiums because they serve as collaboration infrastructure.
They're a destination.
Right. But the Class B and Class C stuff, the commodity offices,
The ones far from transit.
especially those, if it's more than a 10-minute walk from the subway, it is facing severe obsolescence risk.
They're basically zombie buildings.
Permanent vacancy, they might never be full again.
Okay, I want to pivot to the numbers now, because this is the part of the research that I think confuses a lot of people, myself included. The cap rates. Yes. We have this paradox in the data between Toronto and Austin regarding capitalization rates.
I love this part because it really exposes how the underlying market mechanics are changing.
Okay, but you have to walk me through this slowly.
Sure.
Assume I'm 12 years old and I run a lemonade stand. What is a cap rate, and why is it behaving so weirdly right now?
Deal. So the capitalization rate, or cap rate, is basically the return you expect to make on a building if you bought it with all cash. It's your net operating income divided by the price.
Okay, so if I pay $100 for a lemonade stand and it makes $5 a year in profit, my cap rate is 5%.
Exactly. Now, usually cap rates move in tandem with interest rates. If the central bank interest rate is really low, money is cheap.
Right.
So you are willing to accept a lower return on the building, which means you're willing to pay a higher price.
Cheap money fuels bidding wars.
Precisely. Low base rates usually mean high property values and low cap rates.
Got it.
So look at Toronto in our 2026 scenario. Base interest rates are fairly low, around 2.25%.
So by the old rules, property prices should be sky high and cap rates should be tiny.
But they aren't. Cap rates in Toronto are sticky. They're hovering around almost 6%, 5.92% to be exact. Prices aren't booming the way they should.
Why? If money is cheap, why aren't investors just buying everything in sight?
Because of the affordability trap.
Okay, explain that.
Investors are looking at that Toronto lemonade stand and saying, sure, the loan to buy the stand is super cheap, but nobody can afford to live near the stand to work it.
So you can't sell more lemonade.
Right. You can't scale. So they are pricing in a growth discount.
They're literally discounting the value of the real estate because the local businesses can't expand due to the housing shortage.
Exactly. Now look at Austin, Texas. Base rates there are higher, around 3.50%. The loan to buy the building is more expensive.
So prices should be lower and cap rates should be higher.
But cap rates are compressing in Austin, meaning property prices are going up.
Which is the exact opposite of what should happen with expensive loans.
Because investors see the mobility premium.
The mobility premium.
They know that if they buy the lemonade stand in Austin and they need to hire 10 more people to squeeze lemons next month, those people can physically move to Austin and start working right away.
Because there's housing.
Because there's elastic housing,
Oh.
the ability to absorb supply waves is uncapped.
That is fascinating. So the ability to physically move human bodies to a location is worth more to an investor right now than a cheap interest rate.
That is the main takeaway for 2027. Alpha generation making real profit isn't about predicting Fed rate cuts anymore.
It's about capacity.
It's about identifying pockets where labor can physically and financially reside.
Wow. So we've painted a pretty clear picture of the landscape. But landscapes change,
They do.
and the research outlines a couple of triggers that could completely flip the script. Let's start with the good news, the bullish trigger for Canada.
This brings us back to that $200 billion welfare loss we talked about earlier.
The interprovincial trade barriers.
Right. There is a massive opportunity here. If the Canadian government aggressively implements the Free Trade and Labor Mobility in Canada Act, and I mean really enforces it, forcing provinces to recognize each other's credentials, the upside is staggering.
How staggering.
Estimates suggest it could boost Canadian GDP by roughly 7%.
7%. That's essentially $200 billion of free money just by cutting red tape.
It's the lowest hanging fruit in the entire G7 economy. It unlocks that stuck labor force. If a nurse can move from Manitoba to Ontario seamlessly, suddenly the healthcare capacity crisis eases up.
Or the carpenter can move to BC.
Exactly. If a welder can move to the shipyard, the ships actually get built. The friction disappears.
But then there's the bearish trigger. And this involves our neighbors to the south and everyone's favorite topic, trade wars.
Yeah. We are in 2026, and the USMCA, the new NAFTA, is up for review.
Right. Now, we want to be clear to you listening. We're not taking a political stance on this. We're just looking at the economic mechanics outlined in the research.
Exactly. And mechanically, the bearish case is that we get a tariff shock or a highly restrictive renegotiation.
And how does that play into the capacity ceiling we've been talking about?
Well, it changes the fundamental nature of the problem. It shifts the Canadian problem from affordability to solvency.
Solvency, meaning keeping the lights on.
Right. If Canadian manufacturing gets hit with, say, heavy tariffs, those plants don't just struggle to find workers because of housing costs.
They just close.
They become insolvent. The jobs disappear entirely and migrate south to the U.S. to be inside the tariff wall.
So suddenly you don't have a housing crisis in Toronto because too many people are moving there for work.
You have an economic crisis because the work itself has left. It's a very different, very painful kind of capacity release.
Let's hope for the bullish case then.
With hope.
Assuming we do navigate that, who are the winners? If you're listening to this deep dive and you want to know where to place your bets, whether it's your career or your capital, what sectors benefit most as affordability improves?
Surprisingly, retail is a massive winner in markets where affordability improves.
Retail? Really?
Oh.
Everyone keeps saying retail is dead.
Boring retail is dead. Commodity retail is dead. But think about the basic math of a household.
Okay.
If a family isn't forced to spend 60% of their net income on rent because they live in a more fluid, affordable market, they suddenly have discretionary income.
Right.
They buy clothes, they eat out at restaurants, they buy gadgets. Retail thrives where housing is cheap because it frees up cash flow.
That makes total sense. What else?
Industrial real estate, for the reasons we discussed. The construction multiplier effect creates tons of jobs.
As long as you have the power hookups.
As long as you have the megawatts.
Yeah.
And finally, multifamily housing remains the fortress asset class.
Even if housing becomes more affordable and some renters become buyers.
Even then, because people always need a place to live. Workforce housing, nothing fancy, just solid, accessible apartments for normal people in your transit is arguably the safest long-term stability play in the world right now.
So we've covered a massive amount of ground today.
We really have.
We've moved from an era defined by the cost of money to an era defined by the capacity of the ecosystem.
Housing, power, and mobility.
We've looked at the exit fees trapping Canadians, the pressure valves releasing Americans, and we've realized that power cables are essentially the new gold.
And we've hopefully debunked the idea that low interest rates automatically equal growth.
So to the listener, whether you are an investor, a corporate planner, or maybe just someone trying to figure out where to plant your roots in 2027, what is the big so what here?
So what is that? You have to audit the physical ecosystem with the same rigor you use to look at a price tag.
Yeah.
Before you take a new job, before you invest in a real estate trust, before you open a business, you have to look beyond the financial spreadsheet.
You have to ask the physical question.
Exactly. You need to ask, is there actual megawatt availability here? Is there transit accessibility? And most crucially, can the humans I need to run this operation actually afford to exist in this postal code?
You have to underwrite the ecosystem, not just the asset.
That's the perfect way to phrase it.
And this actually reminds me of a brilliant point from Rutherford International in the source material. They talk about what companies have to do if the regional market doesn't provide this mobility.
Right. This is the survival strategy for employers. Their take is that in this constrained environment, you can no longer rely on the old post and pray method of recruitment.
Where you just put a job ad up and hope people apply.
Exactly. If labor is scarce and it's sticky because people can't afford to move, companies have to evolve. They have to build exclusive talent communities.
What does that actually look like in practice?
It means building a relationship pipeline years in advance. It means engaging with potential talent long before you actually have an open role for them.
It's almost like building your own farm system in professional sports.
That's exactly what it is. You can't just go to the free agent market and buy a player anymore because the player can't afford to move to your city. You have to cultivate them, bridge the gap, and give them a compelling reason to join and stay in your specific ecosystem.
Because if they leave, you might not be able to replace them. The replacement simply can't afford the rent.
Exactly. It's about retention through community building, not just handing out paychecks.
I want to leave everyone with a final thought to chew on. We started this whole deep dive by saying we used to be obsessed with the cost of money.
We were.
But today we learn that cheap money can actually be a trap.
It definitely can be.
So ask yourself this. If a region has incredibly cheap land and the central bank has rock-bottom interest rates, but there is absolutely no power available for a data center and there are no affordable homes for the workers,
Yeah.
is that region actually cheap?
Or is it just stranded?
That is the multi-million-dollar question. Thanks for diving in with us. We'll see you next time.